I'm here with Tom Lloyd-Jones, Chief Investment Officer at Zenzic Capital. Welcome, Tom.
Thank you. Thank you for having me.
Yeah, good to see you again. It's great to have you back in the seat. You know, last year we had a good chat. So I guess I really wanted to see. I think you guys are coming up to a 4-year track record now at Zenzic Capital. You know, how's it been going? Chat us through some of the key milestones.
Yeah, no, well, time has flown because as of end of this year, as of end of 2024, it will be a 5-year. Okay. Which has gone incredibly fast. They say time flies when you're having fun, and for most part of it, it has been fun. I think when we last spoke, I think it was just before the sort of the interest rate hiking cycle began. So 2023, I think for a lot of people was it was definitely interesting times, right? Because you were seeing interest rates rise and then credit markets having to sort of readjust on the hoof, if you like. We didn't deploy in 2023 that much. Like a lot of other people, we said we want to see where things go. You know, one of the worst things in credit is when you write credit on the basis of a set of assumptions which change mid-credit, and then you can't do anything. And I think in hindsight, that sort of paring back a bit has served us really well. So our portfolio performed extremely well during 2023 on the historic stuff. We didn't write as much new stuff until we got comfortable on where monetary policy was going to settle, where asset prices were going to land. Then back end now, December 2023 to current, we've written 9 deals, which is, you know, it's like 1.5 a month. Because the opportunity set now, it's certainly what in our pipeline has exploded. There's a lot more confidence that monetary policy has peaked in terms of interest rate cycle, and ECB cut yesterday by 25 bips, Bank of England may follow. That's given people a bit of confidence that there is a sort of a floor, if you like, under asset values, which makes it much easier to write good credit. That's been coupled with quite a large sort of retrenchment from lenders across the spectrum. Banks especially, who are still the main source of credit for real estate, they've retrenched in 2023 quite a lot. They're still in risk-off mode. But now we think is a really good opportunity. I mean, John Gray, CIO of Blackstone, was on CNBC the other day saying you've got the best time to invest is when just before the all clear bell sounds. And that, I agree with him. I think that's where we are now currently. But there's still a gap between the sort of the media driven sentiment of where real estate is, which is primarily office and the difficulties unfolding there, and the reality on the ground. And that gap between sentiment and reality is the breadth of the deployment opportunity. Okay, great. So really interesting to see some of the recent milestones and kind of where you believe things are at the moment. The precipice of opportunity. Let's dive a little bit more into real estate and your particular investment strategies. You know, you're very clear sector specialists, which I think in the business relief space is good. It's a unique diversifier. People are looking for people that are sector specialists rather than when they're looking to diversify, whereas you have some larger managers who have multiple strategies. Tell us a little bit about your current sort of view of the real estate market at the moment and some of the opportunities that you're seeing. No, it's absolutely, we're purely real estate credit. Everybody in the firm is real estate credit and we focus on nothing else. And the view of our market is driven first and foremost is sort of a top-down view. We monitor 25, 26 subsectors within real estate. We look at the operating fundamentals, the supply-demand dynamics currently and where we think they're going to go. And we only invest in sectors where we believe believe the growth is to come. We don't want to invest in sectors purely because they've been invested into for the past 25 years. That's really what's caught people out with office. The fundamentals, in our view, for office have not justified the pricing for many, many years, and now that's starting to unwind. So we've focused for the last 5 years on sectors like residential, purpose-built student accommodation, self-storage, where there is strong fundamentals in terms of the demand for that product, driven by demographic tailwinds typically. So if you look at residential, the long-term structural imbalance between supply and demand due to failure to build enough housing, coupled with population increase. In student, UK is still a global leader in the provision of tertiary education, and that market has not kept pace with the demand for international students in terms of quantity, but also in terms of their quality expectations. I mean, when I went to university, my room was sort of like a glorified cell.
Yeah.
I could, if I put my hands out, I could touch both walls at the same time. Now it's
damp walls.
Damp wall. Yeah. And now it's sort of not far off a hotel type product. But all that stock has got to be built, and it's got to be financed. But the demand is there, and then self-storage. It's a sector that we've studied for many years because it's sort of been under the radar, but now it's really coming up in the sort of the crosshairs of institutional capital. There's so many people who want access to it at an institutional level. They want to buy portfolios of performing stock. But again, they don't want to finance the creation of them. They want somebody else to do that, and then you hand it over to them. And if you can finance that leg of the journey, you can get paid handsomely for it. And the reason they like it is it's sticky income. People put their stuff in storage, they forget about it, but they still pay for it. The risk of obsolescence or sort of getting outmoded through next generation improvements in real estate doesn't really exist in storage. It's a shed with shed with rooms in a shed. So we spend enormous amounts of time on that top-down analysis, but then and say, right, we're only going to deploy money where we believe in those sectors, because we don't want to be on the wrong end of an office shakeout. Then obviously you've got to pick the manager. We say internally, you can never make a good loan to a bad borrower. So we spend an enormous amount. That's probably our second leg. We say even before we've underwritten the real estate or the loan dynamics, we've got to look into the eyes of the borrower and say, we believe in you as people. Then it's the real estate analysis, and then it's the actual structure of the loan.
So clear understanding there of how you are different in terms of a sector specialist and your real estate focus, and really useful to get some colour on that. Purpose-built student accommodation is an area that used to be close to my heart, because I used to live up in Leeds and worked with a developer up there who had, they actually had an apart hotel brand which he launched called Rooms, which was very successful from the Park Lane group. And then he also launched Icon Inc., which I think is the top end of the purpose-built student accommodation market. So an area that I do know. Thinking in terms of how else you differentiate from the kind of other BR managers, can we talk a little bit about potentially, from an advisor understanding of your return profile, the risk associated with your strategy, the fees that investors will be paying?
So dealing with return first. I mean, when we started the product, we felt that there was room and hopefully demand for a product that could stand on its own 2 feet as an investment return, irrespective of inheritance tax relief. That was sort of our fundamental driving belief. And so from inception back, which was Q4 2019, we've returned 6%, which is nearly, if not double, the average return across real estate credit BR products. There are obviously other BR products in different sectors, which have different return profiles. But if you just look at real estate credit in the BR context, that 6% is the top performer and has been since 2019 by some margin. And that becomes particularly important now when base rates are at 5.25. When they were at 25, maybe 3 looked okay. But in our view, now that you're at 5, you've got to provide some return, because all other asset prices are adjusting returns upwards to reflect that. But it's not a trade of risk or reward. You can generate return if you are A, selective about where you invest, B, you can provide sort of transactional speed and certainty to a borrower, and C, you have relationships with them. Money is not completely fungible. Some people think it is, but actually it's a partnership almost between lender and borrower, and they've got to think, right, I'm going on if my loan term is 2 years, I'm going on a 2-year journey with this person. They're my principal capital provider. I need to know, like, and trust them. If things go wrong, I need to be able to pick up the phone to them and get a quick answer. And I need to know that they understand what I'm doing, my sector, my journey. We've got relationships across these sectors going back 10, 15 years. So we're not having to compete in auction processes for deals where the winner is the person who provides the softest terms at the lowest price. We've got no interest in doing that. All our loan opportunities are directly originated outside of auction processes with borrowers we've known for over a decade. And as a result, you can get better returns and a better risk set.
And can you still deliver that at scale? So imagine your inflows, wild success, inflows were all coming in. You've talked about, the 10 or 11
Yeah.
recent deals,
Yeah.
can you still deliver the same returns,
Yeah.
the same risk profile at scale?
We've got an enormous amount of room to grow.
Okay.
There, I would say there's easily sort of like 200, I mean, our pipelines are north of 500 million.
Okay.
There's a huge amount of additional capital that we can put to work within everything that I've discussed. Obviously, once you start, there is a limit though.
Yeah.
You know, if somebody put 5 trillion with me tomorrow,
Yeah.
you know,
Yeah.
I'd struggle. It's that
Deployment
Warren
would be
Buffett.
difficult, yeah.
But we're not at the point where additional capital inflows are going to change the nature of our transactions in terms of risk return profile or quality.
Yeah. And how impactful is real estate values to you? You know, we've talked about, you know, the office market and,
Yeah.
you know, potential overinflation in, you know, office rents and things like that.
Yeah.
But downside protection, asset coverage and things like that, you know, are you protected from that?
It's a great question. Look, valuation is the core of lending, in my view. You've got to be rigorous in your underwriting of value. The way we do it at Zenzic is we first underwrite the value ourselves. We do our own research. We don't speak to a valuer until we've come up with a number that we think is supportable
Right.
in a base, downside and upside scenario. The reason for that is the minute you pick up the phone to a valuer, you get anchored mentally, whether you believe it or not. It sort of implants a seed in your mind that the value should be hovering around that mark.
Yeah.
And you need to do your own work first. In a lot of real estate, and this is why some of the loans have gone bad, is a lot of real estate valuation has been effectively outsourced to agencies, where they've paid for a red book valuation, which is 50 pages long, and there's a number at the bottom, and they've said, right, that's it. But that valuation, there's no guarantee, obviously, that the valuation is right. The quality of the valuation, even if it comes from a top house, depends on the person doing it. You know, you're not getting the chief executive of Savills writing every Savills valuation, but still, you need to do your own work first. Yeah. So we spend a huge amounts of time underwriting value. The office piece that you mentioned, in my view, valuations in part are driven not by just your view of what they should be priced at, it's the flow of capital going towards it. And the real problem with office was that it was viewed as sort of like in terms of a risk perspective, it was compared to trading gilts.
Yeah.
You know, you say you invest into an office block in St. Paul's and you get a 300 basis or 250 basis point pickup over gilts.
Yeah.
Risk profile was totally different in our view, and that's now what's unwinding. But if you're in that market and you want to lend into office real estate credit, and you say, well, I think this should be at a 6% yield, and the market's saying it's at a 3% yield, you've got two choices. You can either stick to your guns and not deploy, or deploy at a 3% valuation yield. Now, that is the other advantage of being in what we call the alternative subsectors of real estate, the growth engines, which aren't subject to vast walls of capital coming in. They haven't been the sort of the poster boys of...
doesn't create a bubble in those subsectors. Yeah.
Exactly.
Yeah.
And now what's happening is the banks are actually now trying this great rotation out of office and retail, who are, just bleeding.
But they still need to deploy. They try to navigate these different subsectors.
But
Could you give us a couple of recent examples then? So I've got a good understanding of the purpose-built student accommodation, the storage, I totally get it. And I imagine an advisor speaking to a client, they would be like, yes, I get it. As somebody who pays every month for self-storage for a load of stuff I definitely don't need, I see the product market fit.
Yeah.
Talk us through a couple of recent transactions and what that sort of deal looks like for you.
Yeah, so I'll cover student first. At the back end of December 2023, we launched our sort of PBSA investment strategy, which was partnering with a very well known and developer of the year actually in PBSA, developer owner operator with capabilities across the three. So can develop, can construct, and has a in-house manager as well to actually run the occupancy. Deep pipeline of assets across the north of England and Midlands, where the strategy was essentially to build a portfolio, roll up and then exit. We think there is significant opportunity in that market to not only access a sector which has strong fundamentals, but which institutions want to pay for. We've already seen now, I think it's Aviva bought 1,000 beds. I think L&G, I think as well, maybe have transacted, but they want scale.
Yeah.
They don't want to buy 150 single beds. But if you can provide that roll up, then you've got something very attractive for them to buy. So that was on PBSA. We're doing a similar roll up strategy in storage.
Yeah.
A little bit earlier stage, but and in part the assets that make a good storage proposition are a little bit harder to come by.
Yeah.
But we've got a very interesting portfolio built around a mix of traditional out-of-town locations coupled with in a more inner-city locations,
right.
Where we think storage has typically gone for the former.
Yeah.
In part because they want massive sheds, and those sort of size lots are more prevalent further out. But there's a big opportunity we think in sort of inner city, serving people who don't want to do a 25-30 minute ride out to do the storage. So we're very excited about the potential there. We'll be seeking to add to our portfolios in both PBSA and storage over the current year. And the pipeline supports that. We've got currently 3 assets in storage, 4 in PBSA. We want to double that.
Okay, so that's effectively the outlook for the year ahead. Then, in terms of sort of doubling, will you see any sector diversification beyond that, or are you very much sticking to your knitting?
Well, we're in residential as well, which we like the fundamentals for. So probably our 3. Buys, if you like, would be residential, which is now quite a broad church because it's not just build for sell, it's build for rent, there's co-living, all within that residential umbrella. PBSA, as I've mentioned, storage. There are other sectors that we really like, but we really like the fundamentals for, but we're not in actively transacting there.
Care home?
Care homes we like. We do like the fundamentals. Obviously, the demographics speak for themselves. You've got to be exceptionally careful who your counterparty is. They've got to care.
Yeah.
It's a very much more...
Not just in the job title.
Yeah, exactly. Putting the care in care. But you have to care about your people there because it's a very important and, from a society perspective, role that you're performing. More and more nascent sectors that we like are things like life sciences, data centres. The office conversion possibility is huge.
Conversion to resi? Or?
Could be resi, could be hotel, could be PBSA.
Yeah.
Something's going to happen with all these massive buildings, which are no longer fit for purpose as office. Yeah. The opportunity set there is enormous. There's been a recent announcement that from another fund manager that they're targeting a 700 million office BTR conversion. Right. Because it's sort of the opposite end of the seesaw of demand. Office demand has plummeted, but residential still there.
Absolutely. This could fill our our housing crisis.
I mean, there's a lot of work to do. You have to be very careful about, is an office, can it work? And how much does it cost to make it work? But it's a really exciting opportunity set.
Great. Fantastic. Well, look, I think we've spoken sufficiently differently to the stuff that we did last time. It's really useful to get, seems like a lot's been happening over at Zenzic Capital. So I really appreciate the time and the catch up.
Thanks very much for having me.
Fantastic. So that's a good catch up with Tom Lloyd-Jones from Zenzic Capital.